You're listening to the Shaughnessy Group podcast, insights on buying, selling, and growing Canadian businesses in the lower middle market. Let's begin.
Welcome back to the Deep Dive. Thanks for joining us again as we step away from the day-to-day noise and really look at what's happening under the surface. Today, we have something pretty special. It's a look into the future of the Canadian market, really. We're dissecting a real-world corporate strategy document. It's called a buy-side mandate.
So yeah, this isn't history. It's a live briefing, in a sense, on what a major public company is planning to do, literally, from day one of the new year. Our mission today is to take this document and use it as a kind of key to unlock the three big things in any major corporate expansion. The strategy, the financing behind it, and the institutional muscle you need to actually make it happen.
Okay, let's unpack this.
And that immediacy is, I think, what makes this so important. A buy-side mandate. I mean, it's basically a formal instruction, a very specific one.
Like a set of orders.
Exactly.
Yeah.
It's a company saying to an advisory firm, go find me this exact type of business, and we're ready to go.
Same.
We're ready to close. It's not just window shopping. It's an active order.
Okay, so it's serious.
Very. And what gives this one its punch is the date on it. January 1st, 2025. That date. It tells you this is a top-level decision. A major player in Canada has set aside the money and the time and decided that, for them, the number one priority for the new year is consolidation. The hunt is officially on.
So let's get into the specifics then. The core mandate. We know the buyer is a publicly traded company in Canada. And crucially, they're looking to buy a similar business. Now, on the surface, that sounds obvious. But that combination, publicly traded and similar business, that really sets the stage for everything else, doesn't it? Why is that pairing so important?
It all comes down to accountability and synergy. When you're a public company, every move you make, especially a big purchase, has to be justified, to Wall Street, to Bay Street.
All right, you got shareholders to answer to.
Constantly. So you can't really afford a long, messy process of trying to integrate some totally different business. By targeting a similar one, they're sending a very clear message. It's two things, really. One, this will be a quick integration. And two, we're going to see cost savings right away. They're not trying to learn a new industry. They're doubling down on the one they already dominate. They're trying to show the market that 1 + 1 = 3.
And that brings us to the mechanism, how they're actually going to pay for this. The document says equity investment. We hear a lot about cash deals or deals financed with debt. Why use their own stock for this?
That's a really sharp observation, and it says a lot about their confidence. Using equity just means the acquiring company is offering the owners of the business they're buying shares ownership in the new, bigger public company.
So instead of just a check.
Instead of just check or taking on a mountain of new debt. Yeah.
But isn't that risky for the buyer? I mean, if you're creating new shares to pay for something, doesn't that dilute the value for your existing shareholders?
It absolutely does carry that risk. There's no doubt about it. And that's why it has to be a deeply strategic move, not just a convenient one. The buyer is basically making a bet. They're saying, we believe the value we're going to unlock here will be so great, it'll completely outweigh that dilution.
I see.
But the real magic is in the alignment it creates and how it keeps the balance sheet clean. For the seller, it can be a really tax-efficient way to exit. But for the buyer, they keep their cash for other things. They don't load up on debt. And maybe most importantly, they bring the management team of the company they just bought on board as co-owners.
So it becomes less of a takeover and more like a strategic merger, a partnership.
Precisely. A partnership to execute on that bigger vision. And that vision has a name, industry consolidation.
That's the core strategy.
That is the masterstroke. It's the disciplined act of buying up your competitors to gain control of a market that's maybe a bit too fragmented. It's what companies do when a sector matures, and the best way to grow isn't just to innovate, but to get more efficient.
So let's talk about how that actually shows up on the profit and loss statement. The coffee shop example is easy to grasp, but what does this look like at a national public company level?
The effects are just profound and immediate. Forget just closing a few extra offices. Think bigger. Company A buys Company B. Suddenly, their combined purchasing power is immense.
Okay.
Instead of two separate companies buying, say, $50 million worth of supplies each, the new company buys $100 million. That leverage gives you way lower costs right out of the gate.
And that's just one area.
Just one. Then you look at technology. You've got 2 different IT systems, 2 payroll departments, 2 different software platforms for talking to customers. You merge them into one, cut licensing fees, maintenance costs, duplicate staff. Those are savings that go straight to the bottom line. It's how they deliver that value they promised shareholders.
That's the upside. It sounds great, but what's the risk? Is there a danger of indigestion? If they buy too many similar businesses too fast, does the complexity of merging all these different cultures and systems just overwhelm them?
That is the single biggest challenge of consolidation. And it's, frankly, the #1 reason these things fail. The plan, on paper, the buy-side mandate, it's only as good as the integration that follows.
So it's a leadership test.
It's the ultimate leadership test. Can you merge 2 groups of people with their own processes and tech without losing your best talent or ticking off the customers you just paid for? So for you listening, if you're in this industry, the risk isn't just about your company getting bought. It's whether the buyer can actually handle it.
A failed merger could destabilize the whole sector.
It absolutely can. But a successful one creates a powerhouse.
Which brings us perfectly to the infrastructure needed to pull this off. A strategy this big, this complex. You can't do this with just your in-house team. So let's shift focus to the organization that's actually issuing this mandate. Their mission is broader than just closing deals. They say they're about assisting Canadian owners, entrepreneurs, executives across the whole spectrum.
And that full spectrum role is so vital here. You can think of them as the high-precision engine in a very big machine. They're not just bringing a list of contacts. They're bringing a structured process. They create competitive tension.
Meaning they find the best possible fit.
Exactly. They need to find that similar business, but not just anyone. They need the absolute best strategic fit, the best cultural fit, the one that's going to maximize all that synergy we talked about. And for that, you need a network that is much, much bigger than just local.
Let's talk about the numbers in the source material because they really jumped out at me. 16,000 global contacts spread across 6,000 different buyers. When you see figures like that, what does that actually do for the public company trying to make a deal?
That's where this stops being a local chat and becomes a global competitive exercise. 16,000 contacts. I mean, that's instant visibility into pretty much every relevant deal happening in this sector anywhere in the world.
Wow.
For the buyer, that scale gives them certainty. It means they can check their math, the price they're willing to pay. They can benchmark it against what's happening globally, not just in Canada, and make sure they don't overpay.
Or that they're making the most attractive offer they can.
The most strategically sound offer, absolutely. Combining their stock with that certainty of execution.
So the network gives the buyer confidence, and it gives the seller maximum exposure.
Exactly right. And flip it around. Imagine you're the owner of that similar business they're hunting. When a firm with a network of 6,000 buyers comes knocking, you know 2 things immediately. 1, this is a serious offer. And 2, if you don't like it, your own team can tap into that same global market to find other bids.
It levels the playing field.
It completely levels the playing field. It neutralizes the advantage a big buyer usually has over a smaller seller. It turns the whole thing into a really efficient market, which is what you need for this to be a sustainable, long-term consolidation, not just a quick snatch and grab.
It really is the difference between shopping at one store and having someone who can instantly show you every similar item for sale on the planet. The whole strategy requires this massive institutional backbone. Okay, let's synthesize this. Let's pull the threads together. We started with a clear signal, a buy-side mandate, kicking off January 1st, 2025. It's a Canadian public company using its own stock to buy a similar business. We've figured out this isn't random. It's a very calculated move for industry consolidation to get more efficient and grab market share. And we see it's all supported by this incredible infrastructure, a network of 16,000 contacts to make sure it's done right. So what does this all mean? What's the big picture here?
The big picture is that consolidation in mature Canadian industries isn't just happening, it's getting more sophisticated. Public companies are confident enough to use their own stock as currency. That's a huge sign of faith in their own future growth after the merger. They're not just relying on debt anymore.
And for our listener?
For you, the listener, this is more than a case study, it's a forecast. When you see a public company announce a consolidation play, you know the speed of competition in that whole sector is about to pick up dramatically. And you have to ask yourself, where do you fit? Are you a consolidator or are you a target?
That leads to an interesting question.
It does. What other industries in Canada look like this? fragmented, maybe with lots of overlapping costs. What other sectors are ripe for this exact same playbook? Because the strategy we're seeing here today will be used in other markets tomorrow.
And that is the perfect thought to end on. If you are an owner of a similar business in this specific industry, January 1, 2025, well, that's not just another day. It's the day the game officially started. Knowing this, you have to prepare. So what's your next move? Do you get your books in order for a premium offer? Or do you start looking for your own partners to build scale so you can be the one doing the acquiring? This kind of insight lets you act, not just react. Thank you for joining us on this deep dive into corporate strategy. And we really want to thank the Shaughnessy Group for providing these insights into how mandates like this are structured and executed. If you're looking for more resources on M&A, on financing, or strategic mandates, we'd encourage you to visit their website, shaughnessy.group. We'll talk to you on the next deep dive.
This podcast is for informational purposes only and is not professional advice. Consult qualified advisors for your specific situation.